let's talk about some more stocks. Jigar Mistry, co-founder at Buoyant Capital, joins us on the show now. Jigar, before we get to the markets and the kind of up move that we've seen in the last 2 months, particularly in individual mid caps and small caps, want to draw your attention to Cyient. I know this has been one of your favorite stocks. You've been betting on Cyient for a while, but can you tell us what has changed in the last few months to warrant an 80% year-to-date gain? What is it? What's the narrative on Cyient now from a market point of view? We know your rationale, but can you tell us what the market is thinking now and expecting from Cyient?
Hi, Rima. Good morning. Thank you for inviting me to your show as always. I think, if you look at the whole IT pack, a lot of these, it's not just Cyient. I would say a lot of these specific small niche businesses are actually picking up very well now. So if you look at the IT index, we have always argued, I think in the past, especially last year, that we always believed that India does not really have a tech business, right? What India has is IT services. And therefore, when NASDAQ corrected, a lot of these businesses corrected in line with it. But over the periods of time, I think what we have realized is that, for example, NASDAQ did reasonably well when that UK business came back. Cyient is specializing in the R&D space. Their the aerospace business is now back. And suddenly people realize that we do not really need to club this with a lot of, your typical IT services businesses because they're following the growth trajectory of their own. And suddenly valuations have not really been as expensive as you would look at the large cap IT names. I think a lot of these select names, I think, are doing reasonably well. And yes, Cyient, we have held for a very long period of time now, I think in excess of 3 or 4 years. So I think that's playing out very good too.
All right. Cyient obviously has worked well for you, Jigar. Good to have you on the show, by the way. Hi, it's Surabhi here. Want to get your sense on some of the consumer plays. And, we've been finding this pattern, whether you're looking at hotel companies. Today we were speaking to DLF. It's very clear that the top end of consumption, the premium end, that is alive and thriving. Is this a part of the market that interests you? And are you looking to add any positions here?
Hi, Surabhi. Good morning. So I think, if you look at the whole spectrum, and it's, it's surprising that since March 28, I would believe the sort of Nifty is up something like 9.5%, but 73% of companies more than 500 crore market cap has actually done very well. Now, if you look at this pack, I think some parts of the spaces that you mentioned is coming back to a lot of attention. Consumption discretionary is one part that's doing reasonably well. And if you look at, the price inflations they have taken on a discretionary actually has taken anywhere between 5 and 12% 4-year CAGR increase in prices. Staples have taken anywhere between 3 and 7% price increases. And now with the possibility of, the global raw material basket cooling off. So you could look at coal prices, which are down, cotton prices, steel, cement, not cement, steel, the LME pack. I think all of them are now cooling off, and the margin hit that a lot of these companies witnessed in 2021 and 22. I think some investors are now sort of very consciously betting that, you could do a reasonably good amount of business here. For us, I think the plays that we are sort of playing this through clearly are sort of 2 or 3 front. One, lower cotton prices, the sort of textile pack is interesting to us. Secondly, cement, I think, clearly stands out here because, your coal prices have corrected, I think, if I'm not wrong, to something like $105. We don't really remember when that was really the case. And that is, cement prices are also off a little bit, and they will be more once the monsoon kicks in. But still, the raw material cost deflation is way too high for a lot of this business to make a reasonably good amount of money. So discretionary, I think we are having some trouble, or even staples, some trouble justifying the valuation despite the increase in margins that you might talk about. But there are still plays within the same bucket that are interesting to us.
Okay, got that. Jigar, thanks a lot for joining us. I also know that you've mentioned that you are looking at NBFCs over banks now. So take us through the rationale there. I mean, banks have been a favorite for a while now. And, even considering the fact that they have rallied, valuations for a lot of them still are quite reasonable, right? Take us through your rationale on why you're looking at NBFCs over banks right now.
Hi, Pavitra. Good morning. See, I think banks, there's nothing against banks. They continue to be a very large part of our portfolio. But as we discussed last time around, the four cycles that you typically associate banks with, right? So we like to break it down into the credit growth cycle, NIM cycle, credit cost cycle, and valuation cycles. Now, within that, I think credit growth continues to remain very strong, and credit costs continue to remain very benign. However, NIMS is one part where we think different banks, depending on how strong they were, to raise their cost of lending when the interest rates were moving up, we'll see some amount of stabilization. Nothing to suggest that they would, deflate by a huge margin, but some normalization needs to happen. And in the process, I think investors have sort of played 2-3 cycles very, very well. So clearly, initially it was say ICICI Bank and SBI over HDFC and Kotak, the way we chose to do it since 2018. Then a few sort of a little more less risk-averse investors choose to go through a huge bucket of PSU banks over other banks. And we did discuss that last time around. It looks like those arbitrages are now over. And therefore, it might be a case where you look at nuances in banks, and therefore now still some smaller banks still make sense. But if you look at the NBFC packs, they actually tend to do very good when your credit cost, the cost of borrowing is sort of flatlining. There is enough credit growth to go around, and by which time valuations also appear very interesting. So, if you look at the MFI space or the affordable housing space, I think those spaces are looking reasonably interesting. Nothing to suggest that banks won't do well. As I said, very large part of our portfolio, but incremental risks are better off taken in, these NBFCs rather than going down the curve on the banking spectrum.
Jigar, thank you very much for joining in today. Even yesterday, we were chatting with Aditya Sood of Incred, and he said he's reducing exposure from some of these large lending institutions and rather focusing more on the insurance side, but you're focusing more on the NBFC side. We'll slip into a break. When we return, we'll be joined by Saswat Guha of Fitch Ratings to discuss an interesting report written by him on the banking sector in India.